Welcome back. Nilesh Shah is now joining us. He's Managing Director of Kotak Mahindra Asset Management Company. We also have Taher, Badshah, Chief Investment Officer at Invesco Mutual Fund. Nilesh bhai, good morning. Great to have you with us here. Taher, good morning. Nilesh bhai, if we can start with you. As I was saying earlier, Der aaye durust aaye. It's good that it's come, and of course it's also come at a time when the market positioning is extremely one-sided. So on the long side, it's very, very light. And I guess that is the reason why this very large 4% gap up, which GIFT Nifty is indicative of. But your first thoughts, Nilesh bhai, is this has gotten done now?
So undoubtedly, Prashant bhai, this is positive from a sentiment point of view. There was a hanging sword on Indian equity rates and currency market because of uncertainty over US tariff deal. Obviously, we stimulated our economy. So from a growth point of view, there was no negative impact. But there were sectors like textiles, aquaculture, handicraft, gem and jewelry, which were getting impacted. Now, this first boosts sentiment. Second, it provides support to sectors which I mentioned. And finally, Prashant bhai, we have to go through the details. Devil is always in the details. We have to wait for the official documents to be released to figure out which sectors are benefiting. In this, there will be give as well as take. So obviously, we have to wait for the details.
Yeah.
Nilesh bhai, morning. This is Reema here. The question is that after so much selling by the FPIs, FIIs in the last 1 year, will the FIIs now come back because of the turn in sentiment? Because earnings-wise, it's not going to change the needle too much, considering the sectors which benefit are very small in the overall scheme of things. But do you see FIIs coming back in a meaningful way?
So in some sense, as Prashant mentioned, the timing could not have been better than this. We have seen December 25 quarterly earnings impacted by labor code and rupee depreciation. March 26 will also carry some impact, but thereafter earnings growth should recover to double digit. Now market obviously tries to discount future. So we are seeing earnings growth recovering from single digit to double digit in FY27. And sentiments have improved. Plus, we also have trade deal with EU FTA, which will get activated hopefully in FY27. Put together, there are reasons for investors to be optimistic about earnings growth.
Yeah, 100%. Let me get in Taher, Badshah as well. Taher, good morning. So what's the investment team and what's been the, I'm sure, Nilesh bhai, you and Taher, both, everybody's been, lesser amount of sleep, lots of calls, getting ready as markets open. Nilesh bhai, you're smiling. Am I right? I mean, I'm getting that feedback from many.
Undoubtedly, we have to, put our data in place. And you want to speak to as many people as possible in absence of official data release.
Yeah, absolutely. Taher, come in there. Your first sort of headline thoughts in terms of, and start with where this will show up. I mean, the GIFT Nifty is up 4, so the Nifty, the large caps, of course, will do well. Financials are a big part of it, so they do well. There are these beaten down, but small list of stocks, right? Directly hit by high tariffs from the US, which will benefit in an outsized way. But what else? Do you think this will change sentiment? And what about mid and small caps, which was where bulk of the pain was really? Will that also get a bit of a lift sentiment-wise, and then maybe stock by stock because of specific, impact because of high tariffs, it may show up. But do you think this broadly provides a bit of a bid across mids, small and mid caps?
Yeah, Prashant, I think so. At one level, we have to, if you were to just put things in perspective, 2025 actually has been a year of extremes, in many ways, whether you look at it from a global standpoint or a domestic standpoint. There have been things which have happened which were never anticipated. For example, the whole gold and silver kind of price movements, the kind of AI trade. You look at the depreciation of the dollar, you look at the depreciation of the rupee, the slide down in inflation. In so many different ways, slide down in earnings as far as domestic India is concerned. Underperformance of our markets, and plus even the fact that, FI sold out probably $20 odd billion, which is a historic peak. So I think in many ways the market has operated at extremes, and therefore a snapback or mean reversion, and at least some of these things, if not all of it, can definitely happen. And I think this provides that catalyst. I think what was probably missing in the budget, the punch has now been provided by this deal, and I think it therefore opens up a lot of things. See, actually, when the trade hit, the tariff hit happened on us. The dislocation in earnings was not as significant in any case to begin with. It was in a few sectors which were, let's say, directly impacted: gems and jewelry, textiles, and a few others, which were the direct the ones which were clearly impacted. But I think, and therefore to that extent, the reversion also as far as earnings is concerned will not probably be immediate. In any case, a cyclical recovery in earnings was expected in 2020, FY27. I think what this deal does is operates at different levels in terms of probably, stabilizing the rupee in the first place. If that were to happen, then as you wanted to know, I think the interest of foreign investors in India will start to kind of, come back a little more, simply because the currency, at least one factor, is relatively more stable. It is a macro reset at one level. It is a policy reset at one level. I think the tone of the communication between the two leaders does seem to suggest that there could be more. There are certain things which are yet not clear. For example, H-1B and a few other things, pharma, and there are issues. I think even oil, for that matter. So to that extent, I think it's a macro reset, and therefore it should perhaps first reflect in multiples. It does probably also open up the door for thinking of earnings strengthening beyond FY27.
Got that. Taher, you would have had a team meeting already by now in the morning. It's been an early start for us, but at Invesco. And what are the big buy ideas now?
You guys didn't still give me a chance to get to office, but nonetheless. No, the buy was basically this, that, look, as I said, I mean, it can operate in different ways. So, for example, if the currency stabilizes, it makes a lot of difference as far as overall the RBI's hands were a little tied down in terms of liquidity and so on. I think that gets a little better. As that gets better, I think it improves the outlook for banks. I think after the budget, there was a little bit of disappointment that the anticipated cut or reduction in deposit rates and improvement in liquidity will come about or no, especially on account of the higher gross borrowing number. I think those recede in the background to some extent. It gives you more policy maneuverability. And I think in other ways, for example, I think tech is also going to be a beneficiary, notwithstanding the pending clarity as far as H-1B is concerned, because that clearly opens up doors. I think in a scenario where the US trade deficit is only going to compress, our ability now to probably compete more effectively for US export market share with countries like, let's say, Vietnam or Pakistan or a few others, that becomes relatively higher. And generally, India has worked well when you have that external stimulus or external markets do well or external economies do well. So I think it will have its indirect implications through many parts of the overall economic spectrum. So today, I think everybody will be a beneficiary. By and large, there will be almost all sectors. Maybe there'll be a little bit of question mark as far as oil and gas is concerned, especially if we were to probably buy more expensive crude. Yeah. But otherwise, I think by and large, I can think of everything probably being positively impacted today.
Yeah. Taher, you said we didn't give you a chance to get to office. We never left office. No, I'm joking. But we were live till 1 o'clock last night, 1 a.m. So we signed off saying good morning and good night, and this morning we said good morning. Doesn't happen very often. It's one of those days we'll remember.
You guys have signed up for something. I have signed up for something else. So.
No. At some level, we all signed up for the same thing. Just a quick word, right? Nilesh bhai, when markets and you get these big gap ups, suddenly 4%, right? And it's a reset in that sense. And what happens? It's happened before as well. You get a flourish, and then suddenly people get to a point where they say, "Oh, valuations are now again too expensive." But then, if this is, as Taher also pointed out, you also said, sentimentally positive, and sentiment is powerful, pieces falling into place, then the earnings component of the valuation argument also starts to move higher, hopefully. Anyway, earnings are supposed to be better than last year. It's one big virtuous cycle, isn't it? Nilesh bhai, any thoughts?
So Prashant bhai, days like this makes us humble and make us believe that time in the market is what makes money for you, not timing the market. Second, a market is driven by fundamentals, flows, and sentiments. even if fundamentals are good and flows and sentiments are bad, then instead of 100, you'll probably achieve 70 or 80%. And when flows, fundamentals, and sentiments are all together, instead of 100, you may end up achieving 120. So fundamentals matter undoubtedly in the long run as stocks are slave of earning. But flows and sentiment also continues to impact short-term movements. And now sentiments will be positive. Flows should start on the positive side. And eventually earnings recovery is coming. But at the end of the day, we still believe the returns of equity markets will majority come from earnings growth and much less from the valuation re-rating. So one will have to moderate return expectation. One will have to stay invested for longer period of time so that you don't miss a day like today.
Yeah, absolutely. And it happens quickly, suddenly, and then markets respond so furiously that it's all done in 2 or 3 days, and you kind of sort of missed out if you, as you said, if you try and time the market and be too cute in that sense, right? Taher, would you agree that on the earnings question, this provides sentimentally very positive on so many layers, right? Because we're only discussing the first layer, but there are so many other ties, B2B, company to company, technology side, and adversarial position was perhaps hurting all of that. And all that kind of goes away. So sentiment positive on layer 1, layer 2, layer 3, and things we can't imagine right now. So that valuation argument sort of perhaps also, you can argue against that, the fact that valuations are very expensive, because you can say this also gives a sentiment boost and perhaps down the line earnings boost as well.
Yeah, so I think, if we were to, the next coming few days, see a maybe 10% rally all put together, I think you would have priced out a little bit of the forward earnings for sure. And to that extent, therefore, it will be, it will continue to kind of, then stabilize at those levels. But it is quite likely that, hello, can you hear me?
Yeah, please go on.
Yeah. So, but what it will definitely do is that it will improve the visibility of earnings beyond FY27. Today, all of us as market participants, while we are all, at least I would say that for myself, that we do expect a cyclical recovery in FY27 simply because of the positive impulses which have been set up in the last year in terms of whether it be rate cuts and even taxation and so on.
Yeah.
Those were in any case supposed to revive earnings in FY27, but we were working relatively less visibility as far as FY28 is concerned or beyond. I think this opens up the door for that visibility to come through. And if markets see that visibility, then maybe valuations beyond a particular point don't ratchet up further, but they stabilize at higher levels. So that's the essential part, and you essentially contain downside.
Yeah. So, Taher, 2,500, 10% is 2,500 points.
Yeah, I'm saying we're done 4-5%, let's say today, based on whatever is visible in front of us, and over a period of the next some time. I think we have to remember that this quarter earnings, at least from what it is visible, is trending quite well. We have still not seen the aggregates. There are a good number of companies yet to report.
And yes, absolutely. The third quarter so far, what we've seen is good. So it's possible, right? You're right. 4-5% is now, and the next few days it's possible.
Exactly. Because the thing is that if you probably get to that stage where we see earnings at least downgrades halting and probably a sign of upgrades coming through, and that essentially will broaden the market as well. To your earlier question of mid caps and small caps, particularly small caps, I think in any case we are of the view that these are typically times when small caps should be bought, because whenever you see this disparity, that small caps significantly underperform, those are good years to gradually accumulate, but not with the expectation that you get your returns in 27, it's 26 itself, probably in 27 and 28. But when they come through and gushes.
Got it. Taher, thank you very much for your time. Great speaking with you. Good insights, and we'll continue chatting. Nilesh bhai, thank you very much for joining us bright and early. We'll leave you to it. Full day ahead. Thank you for joining us.